Government bonds. Government bonds are a way for governments to borrow money from the public to fund various activities, like infrastructure projects and social programs. They are often considered safe investments because they are backed by the government. Let's dive into the different types of government bonds you might consider. Treasury bonds. The safest bet. Treasury bonds, or T-bonds, are issued by the federal government and are known for being super reliable. Think of them like a rock-solid promise from the government to pay you back with interest. These bonds usually have terms that range from 10 to 30 years. They're popular with investors looking for low-risk options, since they're backed by Uncle Sam. Why choose T-bonds? Well, they offer predictable returns and can be a stable part of your investment portfolio. Plus, the interest they earn is exempt from state and local taxes, making them even more attractive. Municipal bonds. Supporting local projects. Municipal bonds, or munis, are all about funding local projects. When cities or states need cash for things like building schools or improving roads, they issue these bonds to raise the necessary funds. They allow you to directly contribute to your community's development while earning interest. It's a win-win. One of the cool things about munis is that the interest earned is often free from federal taxes, and sometimes also state and local taxes, especially if you live in the area doing the borrowing. This tax advantage makes munis a smart choice for those in higher tax brackets. Savings bonds, an investment for the future. Savings bonds are another option where the government lets you lend it money, but these are typically aimed at individual investors. Think of them as a personal promise from the government that includes patriotic bells and whistles. While savings bonds usually offer lower returns compared to other bonds, they're easy to purchase and redeem, making them a great entry point for new investors. Savings bonds come in a couple of varieties, like Series EE and Series 1 bonds. They are designed for folks looking to save for the future, such as for college tuition or retirement. While they might not make you rich overnight, they're a secure way to grow your savings over time. Corporate bonds. Corporate bonds are an exciting part of the investment world. They are like loans that investors give to companies, and in return, the companies promise to pay back with interest. Now, let's dive into the different types of corporate bonds. Investment-grade bonds. Investment-grade bonds are like the A students of the bond world. They are given high ratings by rating agencies, which means they are considered low risk. These bonds come from companies with strong credit histories and are more likely to pay back their debts. Investors like these bonds because they offer more safety, even if the returns might not be sky high. It's like choosing to play it safe for a steady performance. High-yield, junk bonds. Now, let's talk about high-yield bonds, often called junk bonds. These are the rebels in the bond market. They come from companies with lower credit ratings, meaning there's a higher risk of not getting paid back. But with higher risk can come higher rewards. These bonds offer more interest to attract brave investors willing to take the chance. It's a bit like gambling. You might win big, or you might lose, so it's important to be careful and know what you're getting into. Convertible bonds. The best of both worlds. Convertible bonds are pretty cool because they combine some features of bonds and stocks. They start as bonds, paying you regular interest. But what's unique is that you can choose to turn them into a set number of company shares. This can be a great opportunity if the company's stock does well. It's like having a two-in-one deal. You get the steady income from the bond, and if the timing's right, you can jump in on the stock action. In summary, corporate bonds offer a range of investment possibilities. Whether you prefer the steadiness of investment-grade bonds, the thrill of high-yield junk bonds, or the flexibility of convertible bonds, there's something for every type of investor. Exploring these options can help you make informed decisions that match your financial goals and risk tolerance. International bonds. Understanding foreign sovereign bonds. Foreign sovereign bonds are a fascinating part of the global finance world. Imagine lending money to a country rather than a company. That's what happens when you invest in these bonds. Governments issue them to raise money for various projects like building roads or improving schools. Investing in foreign sovereign bonds can diversify your portfolio. They're influenced by the country's economic conditions, political stability, and currency value. For example, if a country's economy is booming, the bond value may rise since the government is likely able to pay back its debts easily. On the flip side, political upheaval or economic downturns can make these investments risky. So, why do people invest in them? They can offer attractive interest rates, especially when compared to bonds from stable, mature markets like the US or Germany. Plus, they provide exposure to international economies, which can be appealing if the investor wants to look beyond their home country. Risks and rewards of emerging market bonds. Now, let's dive into emerging market bonds. These are issued by countries with economies that are growing and developing, like Brazil or India. Just like with foreign sovereign bonds, there's a balancing act between the potential risks and rewards. Emerging market bonds often offer higher yields. This is because they come with more risk. The higher returns can be very tempting for investors looking for better payouts than those provided by more stable markets. However, the risks are plenty. Economies in these regions can be volatile due to political instability, currency devaluation, or sudden economic reforms. One key advantage of investing in these bonds is the possibility of capturing high growth rates as these economies expand. Many investors are drawn to the potential for substantial returns, which can offset the risks. But keep in mind, markets in these regions can be unpredictable. A sudden political change or an unexpected economic policy shift can affect bond values. So, if you're considering investing, it's crucial to do your homework. Understanding the specific economic and political landscape of the countries issuing these bonds can help manage potential risks while aiming for those enticing rewards. Zero coupon bonds. How zero coupon bonds work. Zero coupon bonds, often called zeros, are a unique type of bond that doesn't pay interest throughout its life. Instead, they are sold at a deep discount from their face value. When the bond reaches maturity, the bondholder receives the full face value. Imagine buying a zero coupon bond for $800. When it matures after, say, 10 years, you get back $1,000. The $200 gained over the years represents the interest you would have received if it were a regular bond. These bonds are issued by various entities, including governments and corporations, offering different maturity dates and face values. A critical characteristic of zero coupon bonds is that they are more sensitive to interest rate changes compared to regular bonds. When interest rates fluctuate, the value of zero coupon bonds can swing more dramatically, making them riskier in volatile markets. But they offer a predictable and assured return at maturity if held until then. Who should invest in zero coupon bonds? Zero coupon bonds can be an attractive option for certain types of investors. If you're someone who can wait until the bond matures without needing periodic income, these bonds might appeal to you. They're ideal for those planning for future expenses, like college tuition or retirement, because you know exactly how much you'll receive at a specific future date. Long-term planners, such as parents saving for a child's education, might find these bonds helpful. Since you pay less initially and receive a lump sum upon maturity, it's easier to plan around big future costs. The ability to lock in a specific yield makes zero coupon bonds appealing for structured financial goals. However, they're not for everyone. If you need regular income from your investments or worry about interest rate sensitivity, zero coupon bonds might not suit your needs. Additionally, even though you don't receive yearly interest payments, the IRS still taxes the implied annual earnings, so consider the tax implications. Investors willing to take on the risks associated with interest rate changes, aiming for a straightforward saving strategy for the long haul, may find zero coupon bonds fit well into their financial plans. Municipal bonds. Tax benefits of municipal bonds. Municipal bonds, often called munis, are a favorite among investors who like a little extra tax kick. When you buy these bonds, you're lending money to local or state governments to help fund public projects like schools or highways. The cool part? The interest you earn is usually exempt from federal income taxes. Some cases might even let you skip state and local taxes if you live where the bond was issued. This tax benefit can make a real difference, especially if you're in a higher tax bracket, effectively boosting your return compared to taxable bonds. Imagine not having to share a chunk of your interest earnings with Uncle Sam. That's a huge win. This is why many see municipal bonds as a smart choice if you want to grow your money without the usual tax bite. However, always check specific bond details to be sure of tax breaks, as they can vary based on location and type. Risks to consider with municipal bonds. While municipal bonds might seem like a safe harbor, they're not without their choppy waters. One risk is credit risk, which is the chance that the issuing government might run into financial trouble and struggle to pay back the bond. This isn't super common, but it's always worth a peek at the credit rating of the issuer, which gives a clue about their financial health. Then there's interest rate risk. When interest rates rise, existing bond prices typically drop because newer, higher-yielding bonds become more attractive. This means if you need to sell your bond before it matures, you might not get back what you paid for it. Last, let's talk about liquidity risk. Some municipal bonds are not heavily traded, so finding a buyer when you want to sell can be tricky, potentially affecting the price you get. In summary, while municipal bonds offer sweet tax advantages, it's essential to weigh these against the risks. Doing your homework and understanding the specifics of each bond can help you make smart investment choices that align with your financial goals. High-yield bonds. What makes a bond high-yield? High-yield bonds are like the daredevils of the bond world. Unlike the safe and steady government bonds, these bonds offer higher interest rates. But why, you might wonder? Well, it's mostly because they're seen as a bit riskier. When companies want to raise money, they issue bonds. If the company has a lower credit rating, they need to entice investors by offering a higher yield. Simply put, these bonds are a bit like the spicy food of the financial world, not totally safe, but with a unique kick if you know what you're getting into. These bonds are usually issued by companies that don't have top-notch credit ratings. Maybe they've had some rocky times or they're in a risky industry. Investors willing to take a chance on them can potentially earn more. You'll often hear the term, junk bonds, which doesn't sound flattering, right? But it just means they're not as highly rated, not that they're worthless. Potential returns and risks. Now, let's talk turkey. What can you get out of these bonds, and what might you lose? The big lure for high-yield bonds is their juicy interest payments. Think of them as the candy to the bond investing world. Investors who scoop them up might enjoy higher returns compared to safer options. With lower-rated companies, they pay you more for taking the leap of faith by investing in them. However, these bonds come with some real risks. If the issuing company hits tough times, you're first in line to feel the pinch. Unlike safer bonds where the main risk is interest rate changes, high-yield bonds have credit risk. This means if the company can't pay its debt, you might not see your money back. It's crucial to balance the risk with the potential payoff. So, high-yield bonds are a bit like walking a financial tightrope. They can lead to attractive returns if things go well. But they require careful consideration and maybe even a backup plan if things don't pan out. Climate bonds. Funding a sustainable future. Climate bonds are like a helping hand for a greener planet. They're financial tools designed to gather money for projects that help tackle climate change. Imagine them as special loans given out to support green initiatives. These projects might include renewable energy, clean transportation, or projects that help manage water more effectively. The goal is simple: to support the transition to a low-carbon, more sustainable world. Investors love climate bonds because they offer a way to support positive environmental changes while still earning a financial return. It's a win-win. The funds raised from these bonds go directly into projects that reduce carbon footprints or enhance the environment, making them an essential part of sustainable finance. Climate bonds are becoming more popular for a few reasons. First, there's a growing awareness of environmental issues and the need for action. Governments, businesses, and individuals are all recognizing the urgent need to act against climate change. Plus, investing in green projects can also mean cleaner air, reduced pollution, and preservation of natural resources, which benefits everyone. Key projects financed through climate bonds. Let's dive into some of the exciting projects funded by climate bonds. Start with renewable energy. Many of these bonds focus on solar, wind, and geothermal projects. These projects generate power without emitting greenhouse gases, making them crucial for combating climate change. Transport is another big area. Funds from climate bonds often go towards building and improving public transportation systems, such as electric buses and trains, which reduce reliance on cars and cut down emissions. Then, there's green buildings. These projects aim to reduce energy consumption by making buildings more efficient. This might include installing better insulation, energy-saving lighting, or efficient heating and cooling systems. Climate bonds also support projects that manage and protect water resources. This could involve clean water projects or systems that manage stormwater to help prevent flooding. By investing in these projects, climate bonds play a critical role in driving forward a sustainable future. They're more than just financial instruments. They represent a commitment to change and a healthier planet for generations to come. Inflation-linked bonds. How they protect against inflation. Inflation-linked bonds, also known as Treasury inflation-protected securities, TIPS, are a smart investment if you want to safeguard your money from inflation. These bonds adjust their principal value according to inflation rates. Basically, as the cost of living rises, so does the bond's value, meaning your investment remains secure against the erosion of purchasing power. TIPS pay interest twice a year, based on an adjusted principal. This means both the payout and the principal grow when inflation increases, ensuring your returns keep pace with rising prices. The magic of these bonds lies in their design. They use the Consumer Price Index, CPI, to monitor inflation. So, if the CPI goes up, the value of the bond's principal rises as well. This feature makes them a reliable shield against inflation, offering peace of mind even when prices spike. Best scenarios for investing. When should you consider diving into inflation-linked bonds? They shine in a few scenarios. First, if inflation is expected to rise above average levels, TIPS can be a wonderful way to preserve your investment's buying power. Whether you're planning for retirement or saving for a big purchase in the future, these bonds can help ensure that unexpected inflation doesn't shrink what you have saved. Another scenario is if you're looking to diversify your portfolio with a more stable investment. TIPS can balance out more volatile assets, providing a safety net of steady returns. They are especially useful if you're nearing retirement age and want to protect your nest egg from being eroded by inflation. Lastly, if you're risk-averse and prefer investments that protect your principal, then inflation-linked bonds can be a reliable choice. It's like putting on a financial raincoat in a world where weather patterns are unpredictable. In summary, inflation-linked bonds are a smart choice when inflation looms large on the horizon, providing both peace of mind and stability within your investment portfolio. They help ensure that no matter what happens with the economy, the value of your investment remains intact. Hybrid bonds. Characteristics of hybrid bonds. Hybrid bonds are like the best of both worlds. They combine features of both debt and equity. What makes them unique is their flexibility. These bonds usually have a long maturity period or sometimes no maturity at all, giving companies a lot of freedom. They also typically offer higher interest rates than regular bonds because they are riskier. If a company doesn't do well, these bonds might not get paid back immediately, making them subordinate to other debts. Another interesting characteristic is that hybrid bonds can often be converted into shares of the issuing company. This means if the company does well, investors could potentially gain more value. It's kind of like having a safety net and a chance to soar, all in one package. Hybrid bonds might also have what's called step-up features. Initially, they might offer a fixed interest, but if they aren't called or redeemed by a certain time, the interest rate increases, adding another layer of intrigue to these financial instruments. Why companies issue hybrid bonds now? You might be wondering, why would companies choose to issue such complex instruments? Well, there are several reasons. First, issuing hybrid bonds can help strengthen a company's balance sheet. These bonds are classified as equity for accounting purposes, reducing the company's leverage ratio and making it look more attractive to investors and credit rating agencies. Hybrid bonds also offer a great deal of flexibility. They don't typically come with the same kind of strict repayment schedules that regular debt might have. This makes them appealing for companies wanting to maintain cash flow without worrying about immediate repayments. For businesses looking to expand or undertake big projects, this flexibility can be a game changer. Additionally, hybrid bonds allow companies to attract a diverse group of investors. Since these bonds offer a higher yield, they are particularly appealing to those looking for income. In short, hybrid bonds provide companies a way to raise capital while maintaining a favorable financial standing and nurturing investor relationships. Amazing, right? Callable bonds. Mechanics of callable bonds. Callable bonds are a type of bond that gives the issuer the right to repay the bond before its maturity date. Think of it like an escape clause. If conditions become more favorable, say, interest rates drop, the issuer can repay the bond early. This feature allows the issuer to refinance debt at a lower cost, much like a homeowner refinancing a mortgage when interest rates decrease. When a company issues a callable bond, it usually offers a higher interest rate to attract investors. This higher yield compensates investors for the risk of the bond being called away before maturity. The call option typically can be exercised after a specified period, known as the call protection period. If interest rates fall during this time, the issuer might decide to call the bond, thereby saving money by not having to pay the higher interest rate for the bond's full term. Investor considerations. If you're considering investing in callable bonds, it's essential to weigh the potential benefits against the risks. First off, the higher interest rates offered by callable bonds are appealing. They can provide a better return compared to non-callable bonds, at least initially. However, there's a catch. If the bond is called, you lose the future potential earnings you were counting on. You'll likely have to reinvest your money at a lower interest rate, which is known as reinvestment risk. This can significantly affect your overall investment returns if you're relying on stable, long-term income. Another thing to consider is the bond's duration. In callable bonds, the effective duration, or the sensitivity of bond prices to interest rate changes, can be unpredictable. This unpredictability adds another layer of risk for investors who are looking for stability. Understanding the terms and conditions, such as the call protection period and the call price, is vital before investing. You should also consider your financial goals, risk tolerance, and how these bonds fit into your overall portfolio strategy. In summary, callable bonds can offer great returns but come with risks that might make them more suitable for experienced investors. Always review the bond's prospectus carefully and consider consulting with a financial advisor to decide if these bonds align with your investment strategy. Convertible bonds. Advantages over traditional bonds. Convertible bonds offer a unique blend of features that make them appealing in certain investment landscapes. One of the main attractions is their dual nature. They provide the fixed income benefits of traditional bonds along with the potential for capital appreciation, like stocks. This happens because convertible bonds can be converted into a predetermined number of company shares. So, if the company's stock performs well, you could see higher returns than you would with a regular bond. Another advantage is the lower interest rates compared to non-convertible bonds. Companies often offer them at a lower coupon rate because the conversion feature is an added benefit. This can be a win-win for issuers who want to lower borrowing costs and for investors who might benefit from any upside in the stock price. Convertible bonds also act as a buffer in turbulent market times. If the stock market falls, holders still receive regular interest payments, which is not the case with owning stocks alone. This feature can provide more stability and less risk compared to direct equity investment. When to consider convertible bonds, you might wonder when it makes sense to add convertible bonds to your portfolio. They're particularly useful when you anticipate stock market gains but want to limit your downside risk. Suppose you see evidence of a recovering or booming market. Convertible bonds might be your best bet to capitalize on this growth without the all-in risk of stocks. It's also worth considering these bonds when interest rates are low. Since they typically carry lower interest rates, the loss of pure bond income is cushioned by the conversion potential. They offer a strategic edge, making them suitable for investors seeking a balanced approach to growth and income. Additionally, if you're interested in a specific company's future, convertible bonds can be a strategic way to gain exposure. They allow you to participate in the company's success without immediately committing to buying its stock. This is great for cautious investors who want to test the waters before diving into full stock ownership.